In the alternate version of Quick Study 4.9, we're asked to prepare adjusting entries for expected sales discount. New revenue recognition policies do require companies to report their sales at the net amount they expect. And what I mean by net amount is one of the items we would subtract from sales, just one of them, to arrive at net sales is sales discount. If you recall from working through earlier journal entries, sales discounts is a contra revenue account that represents the amount of cash discounts that buyers have taken advantage of. Remember, a cash discount simply is an encouragement for prompt payment. Maybe the seller offers 2% if the customer pays within 10 days versus taking the lengthier 30-day or 60-day credit period. It's just trying to encourage them to pay a little bit earlier. Now, if a company happens to use the gross method, which we used previously to record entries, so when they made the sale, they recorded the sale at the full invoice price, because ultimately, when they prepare their ending financial statements, they need to show sales at the net expected amount. They need to do an adjusting entry, and they need to reflect the fact of what's the sales discount amount that could be expected based on sales we've made in the past. What amount of sales discounts could we expect customers to take in the future related to those particular past sales? So we're going to prepare an adjusting entry for ProBuilder at their fiscal year ending June 30th, 2016. Currently, they have a balance and allowance for sales discounts of $0 and accounts receivable balance of $11,300. Now, allowance for sales discounts is a new account to us in this particular chapter, and it's utilized within this adjustment process. It's actually a contra asset account. In particular, it's a contra accounts receivable account. It has opposite the normal balance of an asset account or accounts receivable, so its normal balance is going to be a credit. On the balance sheet in particular, you'll see accounts receivable listed, and then you'll see allowance for sales discounts reflected as a subtraction from that. Again, it's a contra asset account. It represents the amount of discount we expect customers to take, so therefore that would be accounts receivable. We do not expect that our customers to pay us. So within preparing or adjusting entry, we need to ask ourselves some questions. First is, where does the balance currently stand within the allowance for sales discounts? Well, right now it's a zero balance, and I've reflected the zero balance on the credit side because the normal balance is a credit. Where do we want it to, what do we want it to be? What do we expect? What do we estimate that our customers are going to take advantage of? If we read through the scenario, of the $11,300 in accounts receivable, 2,650 of it are within the 2% discount period. So that's the amount that could potentially customers could take advantage of the 2% discount. Meaning if we take 2,650 times 2%, our expectation perhaps is that maybe $53 in future discounts arising from this past period sales could be taken advantage of. So that's what we want the balance to be, a $53 credit. If we reflect that we want the balance to be a $53 credit, what do we need to do in order to get it there? Currently it's zero. We want it to be $53. So we're going to have to credit the allowance for sales discount account for $53 in order to get it up to the adjusted amount. What's the flip side of the entry? Well, just like when an actual customer pays and takes advantage of the sales discount, we debit the sales discount account because it's a contra revenue account. When we estimate our sales discount, we also debit sales discount in this instance for the estimate though of $53. Again, that would be shown on the income statement as a subtraction from sales in order to correctly reflect sales at its net amount. What if we change the scenario around a little bit and keep everything the same except for having a zero balance in allowance for sales discounts? Now we're going to have an end of period $5 unadjusted credit balance and allowance for sales discount. So again, what what, does the current balance equal? It's a $5 unadjusted credit balance. What do we want it to be? Nothing else is changing. We still expect $53 in this scenario, so we want a $53 credit balance. So what do we need to do in order to go from a $5 credit balance to a $53 credit balance? We need to credit the allowance for sales discount account for $48 in order to bring it up to a $53 balance. So credit allowance for sales discounts for $48. The flip side of the entry is going to be exactly the same, where we'll debit sales discounts for $48.